investors. This is the second joint event by two of our leading institutes, the Kohler Institute of Private Equity and the Deloitte Institute of Innovation and Entrepreneurship. We have ran a joint event in the past around venture philanthropy, and we are running this second event around angel investments. I don't need to tell you that the issue of angel investors is getting a lot of attraction these days, and what we were delighted to do is basically bring a very high-profile set of panelists to share their experiences, both as angel investors, entrepreneurs, institutional investors, and basically a lot of experience around the theme and the topic of angel investors. When I was asked to moderate this panel, I went and tried to come up with a definition of what angel investor is all about. Now, with many of the themes and terms that we all care about, such as venture capital or private equity, they're quite self-explanatory. Whenever I have to explain what angel investor is, it's a little bit of a problem because the dictionary defines angel as a usually white-robed winged figure which is of superior traits to humans. We'll find out towards the end of this panel to what extent that is the case. What I can guarantee is that we have a substantial experience amongst our panelist members. Before I turn the stage to them, I just wanted to share with you a couple of quick observations. A recent OECD report basically puts the total amount of angel investment in the US at about $17 billion. And the amount in Europe at about $5 billion, and the amount here in the UK at about $600 million. Angel investment is very difficult to capture and measure. The visible and invisible parts of them are quite difficult to come by. What we know even less on is the returns to angel investments. A recent study in the US that have looked at over 1,000 deals by angel investments found that the average cash-on-cash returns was about 2.6, while 50% of those investments have ended up with a loss, and only 7% of that angel investment portfolio have ended up with a 10x return or more. I know that amongst our panels we have some observations and know-how in terms of managing their own investment panels, and we'll find out what are some of the more immediate statistics over here. Another important trend that we've seen in the angel community is different organizational forms. Angel groups, angel networks, they've been far and few in between in the late 90s. We now count as much as 400 angel groups in the US and about an equal number in Europe and the UK. And we see these different organizational forms, different way by which angels come together. And again, we are very happy. I'm very happy to have a group of panelists that have very wide experience and a very particular perspective on this subject matter. Before I turn on to the panel, just a couple of quick words. The first one is that what we'll do is we'll run until about 10 to 8 with the conversation amongst the panelists, which I will moderate. I then want to open it up for questions from the audience, at which point in time, around 8:15, we will end, and I welcome all of you to please join us at the reception 2 floors up at the F1 lounge. Before I do that, and before I turn to introduce the panelists, I just wanted to get a quick pulse of the people in the room. How many of the people in the room are currently angel investors? You've been asked to sit on the left-hand side. Okay, very good. How many of you contemplate becoming angel investors over the next year or so? Excellent. And then how many of you are here because you're interested in raising money, either from our esteemed panelists or from an angel investor in the coming future? Okay, so we have a very nice audience, if you wish, over here. It gives me great pleasure to introduce our panelists. Let me just introduce them by the order in which they're sitting. We have with us Paul Atherton, who is the chairman of Nexion, amongst other companies. He started his first company, Queensgate Instruments, as a graduate student, and has self-identified himself as an accidental entrepreneur, as well as a veteran angel investor in this point in time. He sits on the boards, or he chairs the boards of several companies, and he also involved with the Imperial Ventures, as well as a few other investor groups. Next to him, I'm delighted to have Michael Anderson, who is also been on both sides of the fence, if you wish, both as an entrepreneur in various industries, from printing to e-learning, as well as a veteran angel investor for over 20 years. Next to them, Brandon Stevens, the founder and managing director of Tortilla Mexican Grill, a Mexican grill business with 8 stores strong. And one of the statistics that I like the best, you are selling over 1 million burritos a year. Yes. At this point in time. I can only tell you I'm responsible for a few of those. And finally, last but not least, Elliot Cole from Octopus, who is here to share his experiences as an institutional investor. Elliot has been with Octopus for several years and have worked very closely or served on the boards of a number of their portfolio companies. With that, I want to kick off the conversation for today. The theme is angel investment, and I wanted to start off by asking, what is it that makes for a good angel investment? I want to turn to the two angel investors who are sitting next to me, and so Paul, if you want to kick us off on this topic.
Well, I guess I've been on a bit of a journey in learning what makes a good angel investment, having when I first got rich, about 12 years ago, and decided I'd try investing in other things, I followed what I thought were smart people, and quickly realized that the guys I thought were clever weren't as clever as I thought they were, and rapidly realized that what I was looking for was the smart money to follow it. So the question was always, who's a smart investor in this group? And I realized that most of the time there wasn't somebody. And I realized that the things I was turning down were the things I knew most about, and the things I was interested in investing in were the things that I knew least about. So I quickly got to a point where I thought, actually, this is all wrong. I should be invested in those things I know something about. So I focused in on technology stuff, because I'm a technology guy. And I said to myself, I'm only going to invest if I know really what's going on. I'm going to pile into it and do a few big investments rather than a whole range of little ones. Because I'd seen the kind of John Moulton approach of, 50 grand in 300 companies. And I thought, well, that doesn't work for me. And also, I had a lot to bring. I was at business, a lot of business experience in the domain. So I looked for technology opportunities in that domain that I could build from a very early stage, which I'd done myself, spinning out of university. And discovered they were quite hard to find. It took me 2 years to do the first one, another 2 years for the second one, and I've done 4. I've exited one, and I'm about to exit the second. I'm ahead on my investment so far. My investment in Nexion far exceeds all of that, frankly, because the valuation for the battery company is huge. And I have some very basic rules, which is I must be chairman of the board, executive chairman, so I can fire the CEO and I can control the venture capitalist round and stop them from diluting me to hell.
I started looking at angel investment when I was an entrepreneur in the printing industry, and I think there's a great misapprehension about angel investors, that there is some sort of generic angel investor. In fact, one thing we know is that there are a huge number of individuals, all of whom have different characteristics. And I've been lucky enough over the last 20 years to defy the odds that Gary alluded to, that the returns on angel investments are by and large horrific, and they are skewed by 1 or 2 very large returns which get touted out on a regular basis as being fantastic role models for the industry. But in fact, if you're looking at angels generally, you need to understand that each one is completely individual and has a different way of dealing with investments. And Paul and I are about as different as you can get of two long-standing angels. Paul will invest in technology businesses, and I will not invest in technology businesses. It's pretty much as simple as that. I will only invest in things that I understand, and I understand nanotechnology about as well as you might understand Russian philanthropy. What I think is a common ground about looking for a good angel investment might sound like a cliche, but I was always told that there are only three things that matter in angel investment, and that is people, people, and people. And the more I've looked at what has made my investments successful, I realized that actually that's absolutely true, and that what a good angel investor will be good at is judging the character of an entrepreneur. And particularly, I find, although I'm still not particularly good at judging the winners, I'm getting better at judging the losers. And that's helpful in terms of weeding out poor investments and going from there. But the fascinating thing for angels, and the reason why we enjoy it, in my opinion, is that most of the good entrepreneurs, most of the successful entrepreneurs, in my view, are slightly bonkers. Because if they understood the sort of risks that they were taking, they simply wouldn't start in the first place. And I'm rather embarrassed coming back to the hallowed halls of London Business School, but I have a sort of gut feeling that education is something of a barrier to entrepreneurialism. I think that you can teach the management skills that go around it, but the actual gut feel of entrepreneurialism is something that you just have inside you. And so when I'm looking for a good investment, I will look at the market. I will convince myself that there is a huge and growing market out there. I will convince myself that the company has something not inventive, because that may be Paul's territory, but is innovative enough to bring something new to the market. But above all, I will look at the people, preferably, not an individual, but the team of people who are running it, and work out whether they are flexible enough and innovative enough in themselves to take this company forward to being a much bigger company.
I believe I've heard that both of you very much look at the people and the track record of the team that you're engaging in is one major criteria. I wanted to stay on this point and maybe also bring one of the other panelists and ask you the following thing. In my role as a professor of entrepreneurship, one of the things that I often face is the question, I need to raise money, and who is it that I should be approaching? What is it that I best suited to be raising capital from? And oftentimes, when it comes to venture capitalists, the answer is very easy. I tell the students, why don't you go look at the venture capital website, see what is it that they have funded, and kind of infer whether or not there's an immediate fit over here. Can you maybe expand a little bit more about what are the criteria, what is the profile or portfolio, if you wish, of a venture that you would consider investing in? And I also want to maybe start off with Elliot. I know that as part of Octopus, you have been working very closely with angel investors. That's been an integral part of what you are considering. And so maybe thinking about what is it that's the optimal profile of a company that best suited for you guys, given you're very close working with the angel investors.
So I think you raise a number of interesting points. The angel market has proliferated and professionalized to a great extent in the last few years, and whether or not it's grown is a difficult thing to assess, but it's certainly more visible. And you have platforms like AngelList in the US, where angels can submit their own track record and their own experience in the businesses that they've invested in, and I think the transparency that gives to an invisible market has had a very significant impact on the startup arena in the US, and you're starting to see the impact of that in the UK. I absolutely concur with the way that the angels have framed their own perception of how they view the world, and I agree that trying to generalize about angels and their particular sort of investment mandate is a mug's game. It's very individualistic, and I think there are certain ways you can go about trying to find people who might be interested in your particular opportunity. One of those is to look at the CEOs and chairmen of successful businesses in a market or a sector which is adjacent to yours, because they will know something about your market, they will know something about your opportunity, and if they've reached that sort of C-level position, you may be lucky and find that they have an appetite to invest in your venture, and they'll bring more than money. As far as Octopus goes, well, we also look for teams, and that's the single most important element to our investment thesis. Secondary to that, we're looking to build big businesses, so we look for opportunities which can grow to be very, very substantial, and we measure that in sort of hundreds of millions rather than tens of millions. And thirdly, because we co-invest with angels on every deal that we do, and these angels are angels who've been in businesses and who've built businesses, we look for businesses which will resonate with them, and they have a tremendous empathy with the entrepreneur because they've been in the entrepreneur's shoes and they know how difficult it is to grow a business. So that leads us more often than not to look for businesses which have a business model, essentially a revenue model. We're not the house that could invest in an Instagram or a Twitter or even in the early stages of Facebook, because it wouldn't resonate with the entrepreneurs that we have in our venture partner group who co-invest with us, who built businesses, because when they see opportunities like that, they know how difficult it is to go month after month with no income. So if you look at Octopus, we look for teams, large markets and business models, or at least visibility of a business model.
A company who's trying to get you to fund them.
Right, okay. Well, I think the angel industry is different from the venture capital industry in that it's much more personal. At the early stages, it's much more like a marriage with the investor, and you have to get to know the investor. I think people make the mistake when they're going out to look for investment of thinking they'll just write a business plan, write a prospectus, and the money will flow in. It doesn't tend to work like that, I'm sure. Brandon will echo that sentiment. And therefore, I think you've got to look at it as a much more long-term proposition. And when I was out actually looking for investment rather than putting investment in, I went to the investors months and months before I was looking for investment, because there's nothing more attractive to an investor than somebody who says, I've got a really interesting proposition, I'm not looking for your money at the moment, but I'd like you to look at this, and with your experience, tell me what you think of it. And when I come back to you in 6 months' time, I'm going to have the most fantastic proposition. And building a relationship with somebody who really understands your industry seems to me to be the key to getting a relationship on the right level. And the other thing I would say is that successful investors, wealthy people, tend to be rather private people. They don't really want to put their heads above the parapet. So the people who go to public investment forums don't tend to be the top of the field. And you need to find out by using your networks who these people are. And they tend to know each other. So if you can find out who the expert is in your field, they will know other people who will pull a syndicate together pretty quickly. So understanding who has the expertise in your field is the absolute key to learning who is going to make an investment that's going to be helpful to you, because having an investment from somebody who is unhelpful to you can wreck a business in itself.
Yeah, sure. Well, I agree with everything you've said. it's certainly true that the wealthy guys don't tend to turn up very often to the public forums. I guess I can illuminate this in two ways. One is to say how venture capital firms do it, which is actually very similar to the way I do it, which is to look for very specific domain expertise in building the team. So I tend to try and build a team, and I think both at Sussex Place Ventures and at Imperial Innovations, what we do is we say, well, here's where we are. This is the kind of, whatever it might be, whatever the technology proposition might be, whether it's a radical new imaging technology or whether it's a security thing. You look for somebody in the domain who's got network experience. So I want somebody who I would say, well, I want somebody who used to run a company, who used to be the chief executive of such a company, and I'm going to approach somebody in that sector, both on the supply side and on the market side. So you want to know how the industry works, because that's how you've got to build your business. Those are the people you've got to hire, and the kind of contracts you write there, and then how what your customers are thinking. You need somebody from your customer side who can give you that deep insight. And that's a kind of fundamental recipe that translates, I think, across all businesses. You need that. Whether you need it on the board somewhere or in the management team, you need that effect. But maybe another way to eliminate is to tell you, because I kind of start very early, so I don't actually invest very often in people who come to me with a bright idea. What tends to happen is I get a sniff of something through one of the universities, and I go and see a professor in his office, and he then babbles away on the blackboard, as Professor Minot Green did to me in 2004, and said, look, Paul, if this thing works, this is our new way of replacing carbon with silicon in lithium-ion batteries. And he babbled away on the board and showed me all about lithium and carbon and lithium silicon and Zintel phases, and I was like, wow. I'm good at physics, but I'm not very good at chemistry. And this was electrochemistry. So I went away puzzling over this, thinking, well, the batteries are pretty important. I don't know how important, but everybody thinks they're important. So I went around and I rang several people in my network and said, who do you know who knows something about lithium-ion batteries? They all came up with the same name, Rob Neat. Now, Dr. Rob Neat ran AEA Technologies' battery program at Cullen, and he actually commercialized the lithium-ion cobalt oxide cathode and licensed it out to Sony and Sanyo and Panasonic and everybody. And AEA Technology made $50 million in 5 years on a patent that they had in their cupboard. So I called Rob Neat. I said, well, you must know something about this. Come and see this with me. So I paid him £1,000 to come and sit in an office, which we did. And he said, after 3 hours of listening to Professor Green pontificate in the way only he can, he said to me afterwards over coffee, he said, well, Paul, if this is what it seems to be, it's a pretty, he said it's the Holy Grail. And I said, well, that's pretty, that's good enough for me. So I put £50,000 in to get the research student to do a proof of concept. And I asked Rob Neat if he'd join me as a CEO part-time. And he said yes. So I paid him for a day a week. And I got a research student to do the proof of concept. And a year later, we'd done some tests and we'd actually proved something that worked. Then we went and raised a £250,000 round, and then £1 million round, then a £5 million round, and then a £15 million round, and we raised 40 million about last August. So it starts like that. And of course I brought in all of Rob Neat's friends, all the people he used to work with at AEA Technology, we had all the contacts in Japan that he used to know. So you kind of build a company around a whole network of stuff. And that's a kind of vivid example.
I think if anything, we are learning how diverse angel investment field is all about. I want to use this lead to actually continue from asking what makes a good investment to who makes a good, or who makes an angel investor. And I think the definition that we oftentimes see is a high net worth individual. What I'm hearing the panelists telling me is that it's all about the context and deep know-how of people and the industry context. And it's, there's this element of the financial capability, but there's also an element of embeddedness within a certain industry or within a certain network. I was curious, we had quite a few hands being risen in the crowd in terms of people who are considering becoming angel investors. I suspect that the recent budget has made it attractive in a way, and we might have some time to touch on that. Others also are interested in the dynamic or innovative nature of that. And I was curious whether, and again, I want to talk, I want to draw on your experiences, Elliot, by Paul and Michael. What is one red flag? Something that you've seen that would suggest an individual, maybe you're not right at this point in time to become an angel. And maybe what is one green light, something that suggests that now might be a good time for you to go at it. And so, Elliot, I'm going to start on your end as well. I'm giving you the least time to contemplate this traffic light approach to angel investment. But the idea is basically, as we have, about a fifth of the people in this room thinking how to take advantage of everything that the budget has now made possible, and just jumping into that pool. What is one red flag and what is one?
So if I was an entrepreneur and an angel said I will invest, but I will only be your executive chairman, I'd say that's a red flag for me. A green flag is a track record of investing, so experience investing. I think it's very dangerous when you find someone who's never done it before and they invest in your startup, because there's a lot of learnings to be had from experience, which you can only do once you've actually been on that journey before. And I think it's very difficult to, as an entrepreneur, to manage expectations of a first-time angel.
Brendan, I want to get the entrepreneur's perspective on the topic in a second, but I was curious in terms of Michael and Paul, red flag, green go, any observations that you could share with us?
Well, I have a very big red flag, which is how deep are your pockets? Because there's a sort of perception that this is a betting game, that it's a roulette game, if you like, that you pick your bet, you lay your bet, you get a bit of help from the government in terms of tax relief, and you sit and wait and see whether you've made a good bet or not. I'm afraid that just simply isn't the game that we play. The game that we play involves multiple rounds of investment. If the company is doing badly, it will need more working capital, and if the company is successful, it will also need more working capital. So whatever happens, unless the company goes bust, which sometimes is one of the better solutions, you actually you will need to have the ability to follow on your money maybe multiple times. I think in DHL there were 10 rounds of finance, and it was only the people who went through the whole remit that actually made money. And there's a second way in which you need deep pockets, which is that it's no good investing in one or even two investments, because I think you have to diversify across several, because in the sort of field that we're talking about, there is a certain element of luck in there. And to put all your eggs in one basket, I think, would be a severe mistake. I agree with Paul that I think having 100 investments is absurd, but I think having 6 or 8 would be a sensible approach. And I've been trying to think while I've been waffling what the green flag is, but I have absolutely no idea.
Fair enough. Paul.
Golly. Do you know, I've told people not to do things quite often. I mean, I remember a guy who well, I should be careful not in the audience, but somebody who just joined the E100 Club some years ago, who'd I think sold a chain of shops that his father had created, and was newly rich, and had this great insurance business he was going to invest in. And I said, well, what do you know about insurance? He said, nothing, but it's a great deal. I said, how do you know it's a great deal? And of course the problem is that you don't. And it's, you know, if you're in a venture capital company, what they do is they look around the world for the best model. You know, if you look in Silicon Valley, they're looking at, you know, the Instagram story, but there were 3 or 4 others as well, and the issue was who was going to be successful. Like eBay, there were many versions of eBay. eBay happened to be the winner. A lot of luck around that, actually, probably. Not many people want to admit the luck, but the luck is a big part of it. So I think that knowing what you're investing in is very important. And then the deep pockets. I mean, what can I say? The people I know who make money are people who've got very deep pockets. And if you're going to put 50 grand in, well, you might be able to. It might work with Octopus. I don't know what your. I'd be interested to know what's your average angel investor put in What's an average round size?
So there's a blend from 10 to 50,000 pounds. But I think that the point that you make is the most important, which is you have to have dry powder to follow your money, because otherwise you'll get an instance like Love Film, where the first round was valued at less than 10 million, and the business sold to Amazon about a year ago for 200 million, and the angels who took disproportionate risk at the outset, I think got 2 or 3 times their money.
Yeah.
And that's because many of them didn't follow in the later rounds, and they were washed out by the likes of some of the European venture capitalists.
Yeah, that's the big problem.
Yeah.
You get washed out if you can't follow, and the venture capitalists come in with a 3 times liquidation preference when the company needs a lot of money and you can't follow. I mean, my guess is it takes, in the kind of arena I'm in, if you're in the battery industry, it costs a lot of money. But most of the businesses, you could probably get them to market and get some money back if you invest £3 million. Less than that is pretty hard. Yeah.
And so I'm hearing something very interesting, because I think part of the rationale for what we've seen in the budget and the way that people attempt to encourage angel investment, and frankly the reason why it became more and more popular, is because there's this equity gap. There's this equity gap between seed funding and maybe A and B round funding, and the idea was that angel investors, just in terms of the amount that we are talking about, might be best suited to plug that equity gap. And I think where the conversation here is come to be is that if you're an angel investor, plugging a hole in our society's entrepreneurial funding is one thing, but how do you make sure that you don't just make a 2-3x given the returns that you have basically, given the risks that you are basically taking on? I want to revisit this issue in a second. Before we do that, Brandon, you've had a chance to hear a little bit kind of the behind the scene of how angel investors are thinking about it. You've actually ventured and had got yourself some as an entrepreneur. And I was curious from your perspective. We've heard deep pockets. I'm sure that it's never bad to have an investor with deep pockets, but maybe you can keep us honest. What were some of the experiences that you've had as an entrepreneur who's receiving, as a recipient of angel investment?
I suppose it's probably a slightly different perspective. Michael knows a bit of the history of Tortilla, but we've raised £4.8 million over the course of 4.5 years. First round of kind of 435, then 380, then 280, then 1.1 million, then 2.8 million. And so what is an ideal investor? Obviously it's deep pockets, because it'd be great to go to one person, have them put in a ton of money, and then what do you want? You definitely don't want what Paul's insisting on, which is that they take over the chairman of the board. So what do you really want? You want somebody who's going to put in a ton of money and leave you alone. I mean, that's the actual facts of it, right? What is the actual reality of the situation? It's great to talk about ideal investors. Actually, when you're raising 435,000 and you have to do it from 20 or 30 people, and you're getting 5 grand here, 15 grand there, 50 grand there, you're just happy anybody's picking up the phone. You don't care who that person is, as long as they're putting in money at the valuation you want. So I don't know. It's a luxury to actually be able to pick and choose and say, oh well, this person's going to bring an incredible amount of value to the business. Actually, they're going to be a complete pain in the ass, but they're going to put the money in, and that's fantastic. I mean, we're in a point now where it's fantastic. We're in a good situation. We raised a huge amount of money, and we've just had the CEO of Yo Sushi join the board. We've got the former finance director of Pizza Express, who's also the CEO of Clapham House, which owned GBK and the Real Greek. Those guys bring an incredible amount of value to the board. But that doesn't happen. That's not an angel round. That's a venture capital round. That's raising multi-million pounds from a company that has $19 billion under management. I guess that luxury comes later than maybe ideally it would. Now that it depends on who the entrepreneur is.
Did your angels get to participate in the venture capital round?
No.
Exactly.
Yes.
Right. The venture capital won't let them, right?
Yes.
So this is the danger you face
Yes.
as the angel. So those guys did you a favour to get you started. But what's the liquidation preferences?
It depends on whether they invested in, if they took EIS shares or whether they went for A preference shares, and which was actually whether they're a UK investor or whether they're a US investor. But absolutely, we had to persuade them you reach a certain point, which Paul's alluding to, which is, you get to a certain point where we raised 2.8 million. We actually got some of the existing shareholders to sell out some of their shares, which meant that it was a 3.5 million pound round. They actually don't. The guys that did the investment, they don't even allow for investments for less than 4 million. They have a minimum. They have a minimum amount that they want to put in, because obviously they have to spread all their time across all these different things. They'd rather put in, as these guys will attest to, they want to put in 10 million or 15 million or 20 million. They want to buy out all the shareholders. So to cause them to allow them to have enough money to put in to meet the minimum guarantee, we had to cause all the existing shareholders to not exercise what's called preemption rights, but their rights to invest in future rounds. They weren't happy about that. We had a huge amount of arguments, and it was a huge battle. But to go back to the first round's brutal. And we raised a tiny amount of money from a bunch of different people. And what I found is actually the people that put in the most money were the people that asked the least amount of questions, left us alone to get on with things. And the guys who put in 3,000 or 4,000 were asking me questions all the damn time.
So I think one of the issues that immediately came to the forefront is this seam, if you wish, between angel investors and more institutional players. And I hear that in the conversation that we've had earlier. And I think that if we ever thought that we have a diverse set of panelists, I think this issue comes out in the perspective on this particular topic. And I know that each of you hold quite strong opinions on this topic. And so let me maybe start with this conversation. The reality of it, to the extent that the investment amounts are quite deep, and the consensus is that they are going to be deep, at some point in time, the angel might either start off with an institutional investor alongside, or have to work with an institutional investor along the road. And I was curious as to what are some of the experiences, some of the observations that you've had, the degree to this works well, and what might be some of the elements that help that work more effectively. And I want to start off by the order in which you're sitting. And so, Paul, if you can share us with your experiences, and I think you've alluded to the way you're thinking about it, if you can maybe expand on this, the seam between institutional and angel investors.
Well, I'm chairman of Infinitesimal, which is a semiconductor defect inspection. Some people call it nanotech company. And we had an offer. We went to Atlas to raise some money, and they offered us this deal, which was 3 times liquidation preferences. And we all looked at each other, all of our investors, and we said, these guys are just going to take everything. And we said, we're just not going to do that. And we turned them down. They were astonished that we turned down an offer, term sheet offer from them. But we turned them down and we funded it ourselves, which I'm glad we did, because we retained control. And I realized then that, those guys will just have me for breakfast. So how do I find somebody who will trust me? Well, I have to get close to a venture capital company. I have to work with them. I have to work with them to the extent that I add value and that they want to do another deal with me. So there's a long-term game. It's a repeat game. So they daren't cheat me, because if they do, then maybe I'll cheat them. And so it's a tit-for-tat kind of thing. So I've sidled up to a couple, and I work with them on the board, and they co-invest with me, and I control it that way. But it's quite a difficult thing to do. In technology, you kind of have to do that, because the sums of money are so large that you couldn't do it all from your own pocket.
And so there's a small set of VCs that you've learned to develop relationship with and co-invest along with.
Yeah, and help them out and do some things for them. Do them favors, get to know them in a way that means that it's a repeat thing.
So we've heard some experiences from more technology-focused areas in companies. Michael, you self-confessed to do very little with these kind of companies, yet I'm sure you've worked along with institutional investors. And what have been some of your observations in terms of how to enable that seam in a most seamless manner?
Actually, I have never had a venture capital company come into a company that I have invested in. My preference is always to sell out before they come in, to make a trade sale. That tends to be the way that I would make a return on the money. I'm very nervous of working with venture capital companies, and if I was to do it, I would do it on the Octopus model, which I'm actually a great fan of, where you're in with them from the beginning, so everybody's on the same side. And I think whatever you're looking at in angel investment, I think one of the key aspects is for everybody's interests to be aligned. And I think as soon as the one party's interests are different from another party's, whether it's the management, the original investors, the venture capital investors. As soon as it gets out of sync, you're going to have problems sooner or later.
I want to jump over for a second, Elliot, and it is the case that Octopus has a maybe more innovative or unique model in terms of bringing the institutional money and the angel community. So if you first can describe to us what it is that you do, and then maybe share what is the value proposition for those angels that work with you, that they see in becoming part of your network.
So before I do that, I feel like I have to stick up for the VCs here. You're on a hiding to nothing if you generalize about entrepreneurs, and I think you're on a hiding to nothing if you generalize about VCs. Actually, there are many different breeds and colors, and one of the tasks of being an entrepreneur is to filter that market and find someone who's the right partner for you, because when you get the right partnership, wonderful things can happen. When it becomes misaligned, then the outcomes are less good. The point about Octopus, which is quite interesting, the ventures team within Octopus, is that the four guys who set it up were actually businessmen, and they'd had successful careers in different fields, food industry to manufacturing to corporate finance, and one was a trader. And they'd all angel invested themselves, and they weren't very good at it actually. They kept on losing their money. And they recognized that they needed a blend of skills to really be an effective unit as an investor in early stage and startup companies. So they began sort of building this network of venture partners. And that network now numbers about 110 individuals, and they have a sort of common trait to them. They are all entrepreneurs and businessmen and people who built businesses, who understand how difficult it is to build a business and have incredible empathy for the entrepreneur. And so alongside this group, we also have the funds that Octopus raised for us. And so we've got about 250 million under management, and the angel group itself has invested about 30 million over the last 11 years. And we've invested in about 30 to 40 companies, and the IRR is about 33% realized IRR at the moment, which equates to a pretty good return on your money. And this is not a normal sidecar vehicle, because normally you have VCs who have then a loose affiliation of people that they work with, who they invite to a deal, and those people will be a small number, whether they're called entrepreneur in residence or venture partners sometimes, and they'll be invited to a deal. We've actually flipped that model. So when we find an opportunity, the first thing I ask myself is, will this opportunity resonate with our venture partners? Because I'm going to put this deal in front of my venture partner group, and normally 25 to 35 of the venture partners will attend a meeting. They self-select, and they have complete discretion as to whether to invest and how much to invest. And if we can persuade these guys to invest in a deal, then we know we've got something special, and then our funds will come alongside, and they come alongside on exactly the same terms. And we also offer those terms to every kind of existing investor, because we recognize the importance of aligning investor interest. And the reason we do this is if you ask someone for their advice or their view, certainly people in Britain are too polite to give you anything really on the whole other than quite a balanced response. Here are the strengths, here are the weaknesses. But if you ask someone for money out of their own bank account, if they give you any other reason other than yes, I'll invest, then you have to start asking questions as to whether the opportunity is of interest. And speaking to one of the other points about having a breadth of a portfolio, having this group of people who built businesses who we can leverage enables us to look at nanotechnology to food technology to DVDs through the post like Love Film. And if I turn to talk about a business called Graze.com, which is a bit like Love Film but food through the post, we were able to get the business in front of Paul Daniels, who runs Daniels Food, which created Johnson's orange juice and Covent Garden soup, the lady who ran Tesco's in Ireland, and the gentleman who ran R&D for GSK Europe. And we're able to leverage off their expertise along with all the founders of Love Film, who are also part of our venture partner group. And that gives us the confidence to invest in an opportunity because we're leveraging their expertise and we recognise the benefit that their deep domain knowledge can bring to us.
And so I guess, Brandon, it's left for you to share. You've lived with the reality of actually managing that kind of transition. And we've heard a little bit polite but diagonal views on what does it mean to actually have institutional and angel investors over there. From your experiences, how did you manage the transitions? What have been some of the pain points from the entrepreneur's perspective?
Nightmare. Only Breakfast with John Bates saved me and got me through the entire ordeal, actually. So I mean, we had a very interesting situation, which is we had raised a number of different rounds. We then raised a 1.1 million pound round, which was funded partially by the existing shareholders, but partially by an institutional investor. The institutional investor was the wrong match, and so he was. The fund manager was investing more in AIM-listed companies and needed certain market protections that he was used to. And when it came to time for a bigger fund to come in, where we actually had to kind of force him or persuade him to not exercise his preemption rights, he wanted an unbelievable amount of protection and was basically convinced that these new shareholders were going to come in and just completely screw him in every possible way. These guys being a $19 billion fund who owns Yo Sushi and has an enormous amount of credibility in the market. As a result, he actually blocked the entire deal from going through. So we started in, I think, November. We got through in about June. We had everything done. We were ready to sign the documentation, and he refused to back down on a couple of kind of absurd situations, to the point where we were threatening almost legal action. We then had to go out to the entire private equity base. We went to Piper, Penta, Phoenix, ISIS, Risk, and talked to all of them, came back, realized that we had the best deal possible, and we basically forced these guys to acquiesce on some of these deals and finally, or some of the terms, and finally got the deal done. But it was absolutely unbelievable, and it was the most challenging thing I've ever been through in business. The one thing, towards the points that Michael and Paul were mentioning, we did find a way to align some interests, in the sense that we have liquidation preferences being aligned between all the different shareholders, so that's good. But these new guys do come with a different share class, a different set of rights. They have consent rights. They can veto lots of different things, and it's a matter of just trying to balance the various needs, from the smaller shareholders to the mid-cap institutional guys to a $19 billion massive fund. And yeah, it's just been. It took a year. What can I say? It was horrible.
So, thank you for that. I think we've traveled quite a big journey, talking about who is an angel investor, what is an angel investment, and then thinking about some of the seams between angel, institutional, and so on and so forth. Gentleman over here. Yep.
Edgar Miller is my name. I have a question for Paul. You were explaining your sort of preferred VCs that you work with, but what I haven't quite understood from that discussion is how you keep yourself from being diluted, because either your guys have got to pony up the money, or there isn't going to be very much future investment required. I mean, how do you get around those mathematics?
Well,
I mean, however nice the VC may be.
yeah. Let's assume you get the first round away. Now I'm chairman, so I have to raise the next round. I do the fundraising.
Right.
So they can choose not. They can make me an offer, but I can also say, well, at the same time, I could put money in and dilute you, or I could find somebody else to dilute you. So the question of whether they're going to follow their money and on what terms has to be negotiated a bit more.
Well, okay. My question is this: it strikes me you've either got an unusually a group of angels that have unusually large pockets.
That's true.
Or you have ventures that don't require much future funding, because one way or the other, you've got to get the funding.
Yeah.
And you're going to have to get it from somewhere, whether it's a VC, and people are not stupid. They're going to ask for certain returns. How do you? I don't quite see how your model gets around that.
Yeah, well, in practice it does, because when we're on the third round, the question is, under what circumstances will the management team get diluted, and will I get diluted, and will early investors get diluted, and will they dilute themselves? And in my experience, it makes it a more benign environment.
So you're mainly focused on liquidation preferences. Is that what I'm getting from
Well, yeah, it's true to say that there's always a new class of share come in, and it's got different rights to it, depending upon who's in the round. The question of whether liquidation preferences and the way they work it needs to be negotiated, and there's all sorts of ways of doing that. So, you can have catch-up. There's catch-up clauses with liquidation preferences that you can get in. You get very benign ones and very aggressive ones.
James Clark from the BBC. Look, I've just got a question. Given that tomorrow's angels come from today's shareholders, when you're investing, this is for the whole panel, when you're counselling your entrepreneurs, do you advise them to open a certain amount of the equity to go towards share options? And if so, how much do you advise them to open up?
Yes, we do. We see it as really critical, and we see it as a sort of maturity of the CEO that he's willing to do this, because often he has to attract, part of the role of the CEO is to attract top-tier talent and pay them peanuts. And if he can persuade someone to believe in the mission, the vision, and make it worthwhile by options, then that's a good sign for us. So I jumped in. You were going to say
No. It is all about trying to persuade them with options and pay them peanuts. And I mean, cash flow is key, and not just cash flow, but just cash itself. We have an incredibly capital-intensive business. It's about £400,000 every single store. For £400,000, Paul could have an application that reaches the entire world, on iPhone, right? So, yes, we try to watch that, and the answer for us is 15% of the total share capital is allocated to potential options that could be issued. But of course, you issue those options, you do dilute yourself, and so we're very, very careful about how much we give away.
Yeah, 15% is the number that I use typically. Because it always gets complicated when you raise another round, and then the question is, do you reload?
We reloaded.
And if you reload, does that mean that management don't have any? If management are always going to get reloaded in order to preserve their incentives, then of course they don't care very much about the price of the round, because they're not getting diluted at all.
Only if they're taking some of it. But I mean, we had 15% on the first round, and then once we got to the fifth round, we said, okay, let's revisit this again, and we increased it, because at that point, but also the business plan had changed. I mean, we had kind of gone from let's do 15 stores to let's do a large multiple of that. So at that point, the team's going to be bigger. The amount of options you're going to have to issue is bigger. It's the same business, but it's a different business plan.
Is your question around, because the tax effectiveness of options is very poor. There's a lot of leakage. 50% of the money goes to the HMRC, whereas if you've got equity, only 10% goes to HMRC, and that's a big difference. And so people are starting to use these growth shares now. I don't know if you're aware of those.
I mean, there's EMI options, which are incredibly tax beneficial. So I think it's a 10% thing, but
you run out pretty quick.
Yeah, you run out of it, and there's all kinds of thresholds that you can't breach. I mean, it's tricky, but all of the guys we've got 6 employees that have options, and they obviously it does the trick. I mean, they are vested in that business, and they are excited, and they're fired up.
Yeah, I think the question was based around the fact that when the company exits, obviously your shareholders are the ones who benefit directly and become the next generation of angels. So it's about propagating businesses through the expansion of potential angel networks.
I think that's a really good point. I think using the word exit means one thing to an investor, and actually strikes terror into management teams, because they're not exiting at all. Actually, they very rarely do they get to walk away, and it's a sort of it is important to kind of really to frame that dialogue with management teams. Look, certain shareholders need a return on their money, and we need to upgrade them anyway, because we want to continue with the mission, and here is also an opportunity for you to take money out. And I think if you look at the West Coast, one of the things that the Californians excel at is having this sort of cycle of investment, which look at the number of millionaires that are going to be made on the IPO of Facebook, Sadly, precious few for Instagram, probably like 10. And I think all those guys, you look at the PayPal mafia, and if you look in this country, actually, TechCrunch coined the phrase the love film mafia, which is sort of laughable because it's so small, but Octopus has benefited by actually backing another 5 businesses from love film. And Zoopla, Grays, Secret Escapes, True Knowledge, and ECN Live, all have their sort of heritage in love film. And I think if you look at other tech stories like Betfair and some others, you'll see that sort of cycle. I think it is important.
Yeah, I'm trying to link some of these things together. The early stage investors that get washed out and never make money, the employee share options, which have to keep resetting ways or may not be worth money. And then a couple of events we've just seen. One was it the Zynga guys that just cancelled all the options, all the options for the management. Yeah, we're about to exit or IPO, whatever we're going to do. So we're just going to tear up those remits. That's happened. A couple of ventures in the States. So all the little people who lose. Meanwhile, there was another case, and I can't remember which business it was, in the last 3 months, where the chief executive ran around just prior to an exit and said, there's a whole lot of people here who we didn't take care of, and I'm now going to splash a whole lot of shares around and make sure people who within the early years get care. So I think there's a question of ethics here for people. Do we just say that's life? Business is business. Or is there some ethics? I mean, for example, for you, Paul, it seems to be your strategy is I'm going to make myself indispensable because I have a funny feeling everyone's going to try and get rid of me at some point. Seems like a good strategy. Brandon, you sort of, I don't know, it seems to me that you've kind of, you've been through the mill and now you've got the big investors and sorry that my little guys are all washed out. That's life. Yeah. Would you feel guilty about them? And if you raise money again, would you accept angel money?
I didn't feel guilty at all because the return that they had, because there was an exit opportunity. We went to them and said, hey, guess what? You're actually going to make.
They made money. They weren't.
You're going to make 3x return in what was 3.5 years. So it wasn't coming to them with a, hey, I know, sorry you're getting screwed. I mean, it was like, hey, this is a great opportunity. And by the way, you may not get an opportunity for another 3, 4, 5 years. So take it.
I misunderstood. I thought.
But then, and their response to us was, yeah, but you're about to get all this money. Why the hell would we jump out now? And so, yeah, I mean, it created quite an enormous amount of tension, as I think you know. But I don't know if the first guys get messed around all the time. It depends on the situation, of course.
To close about, I think if I take stock of what it is that have actually happened here, we've learned that there's no one-size-fits-all. I think we've seen very different types of angel investors that are happily coexisting amongst each other and doing so for quite a long time and quite successfully. And I think that if there was ever a domain where you want to embrace the heterogeneity, is the one of angel investors. We've also heard returns that sound quite positive and in fact quite attractive compared to other asset classes, and that's an important thing in by itself. I think the last point that we've heard is that the 2012 budget is going to make it so that in the US there's going to be a lot of interest in angel investment. And one of the things we want to think of are what are some of the red flags for doing so, as well as it's great that we are plugging an equity gap, but what is the overall ecosystem and how can we make sure that all of these players, angel and institutional, best work together. And with that, I wanted to give a big hand to our panelists, so please join me.